Term insurance is often one of the first life insurance options people hear about, and for good reason. It can provide a large amount of protection for a set period of time, often at a lower initial cost than many permanent policies. For a young family, a new homeowner, or a professional building financial stability, that can be a powerful tool. If something unexpected happens during the term, the coverage may help loved ones pay the mortgage, replace income, cover education costs, or keep daily life moving. But term insurance has limits. Understanding those limits is just as important as understanding the benefits. The first limitation is right in the name, term. The coverage is temporary. A policy might last 10, 20, or 30 years. When that term ends, the protection may end too, unless it is renewed, converted, or replaced. That can create a problem later in life. Your need for protection may not disappear just because the policy expires. You may still have a spouse who depends on your income, estate concerns, final expenses, a family business, or other responsibilities that continue beyond the original term. The second gap is cost over time. Term insurance can be affordable when you are younger and healthier. But if you try to buy new coverage later, premiums may be much higher. If your health has changed, getting coverage may be more difficult, more expensive, or sometimes unavailable. The third limitation is that term insurance usually does not build cash value. It is designed mainly for death benefit protection during the covered period. If the term ends and no claim is made, there is typically no savings component to use, borrow against, or carry forward. That does not make term insurance bad. It simply means it is not designed to solve every financial planning need. Think of term insurance like renting protection for a specific season of life. It may be exactly what you need. While children are young, debts are high, or income replacement is the top priority. But permanent needs may require a different tool. This is where a broader plan matters. Permanent life insurance may help fill long-term gaps because it is designed to provide coverage for life as long as policy requirements are met. Some permanent policies may also build cash value over time, though costs, guarantees, and risks vary by policy type. Critical illness riders or standalone coverage may address another gap: surviving a major health event. Life insurance often focuses on what happens if you pass away. But what if you live through a serious illness and still face medical bills, lost income, or major lifestyle changes? Critical illness protection may help provide funds during that disruption, depending on the policy terms. Disability coverage is another important piece. For many working adults, the ability to earn income is their biggest financial asset. Term life insurance may protect your family if you die, but disability insurance may help protect income if illness or injury prevents you from working. The key is not choosing one product in isolation. The key is matching coverage to risk. Ask, how long will my family depend on my income? What obligations could outlast my term policy? What happens if I become ill but survive? What if I cannot work? What coverage do I want later in life? Term insurance can be a smart foundation, but it may not be the full house. A strong financial plan looks at temporary needs, permanent needs, income protection, health risks, and future flexibility. It uses the right tools for the right purpose instead of expecting one policy to do everything. Before making decisions, review your situation with a qualified financial or insurance professional.